Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are cracking open one of the most iconic names in enterprise software. Lana, we're talking about the company that literally invented cloud CRM.
Salesforce, ticker CRM. And Hudson, the timing here is fascinating because this stock is sitting at levels we haven't seen in over 2 years, down 30% year to date, while the underlying business just posted its fastest growth in 8 quarters.
A disconnect like that? That's exactly why we do this show. Let's get into it. So Salesforce was founded in 1999 by Mark Benioff, a guy who left Oracle after 13 years as their youngest ever VP, and he literally started this company out of a San Francisco apartment with one radical idea: the end of software as we knew it.
The idea was simple but revolutionary. Instead of buying expensive software, installing it on your own servers, and hiring a team to maintain it, what if you just logged into a website and it worked? That was the birth of software as a service for the enterprise.
And Benioff didn't just build a CRM tool, he built an entire ecosystem. Today, Salesforce runs what they call Customer 360. That's Sales Cloud, Service Cloud, Marketing Cloud, Commerce Cloud, Platform, including Slack, and now Data Cloud and their AI layer. They went public in 2004 and have grown to $41.5 billion in annual revenue with over 76,000 employees.
The business model is beautifully sticky. About 94% of revenue comes from subscriptions and support. Once an enterprise wires Salesforce into its operations, its sales pipeline, customer service, marketing automation, the switching costs become enormous. You're not just changing software, you're rewiring how the entire company interacts with its customers.
And that's before we even get to the ecosystem. Over 5,900 apps on AppExchange, 16,000 partners globally, and millions of developers in the Trailblazers community. It's like an operating system for business relationships.
Exactly. And that ecosystem is Salesforce's deepest competitive moat. They hold 21% of the global CRM market, more than 3 times the nearest competitor, which is Microsoft at roughly 6%. They've been number 1 for 12 consecutive years.
All right, Lana, let's get into the numbers. This is your domain. How does Salesforce look under the hood?
Let's start with valuation. At a share price of $170.85, Salesforce trades at a trailing PE of 21.4 times earnings. The forward PE drops to just 12.9 times, which tells you the market expects significant earnings growth ahead. Price to book is 2.7 times. EV to EBITDA is 13.4 times. And the PEG ratio is 1.7.
So for a company that dominates its market the way Salesforce does, those multiples actually feel pretty reasonable. The forward PE at 12.9 is lower than the S&P 500 average.
It's remarkably compressed. For context, ServiceNow trades at 55 times earnings, Oracle is at 36 times, Microsoft is at 33 times. Salesforce at 21 times trailing and under 13 times forward, that's the cheapest this stock has been on a forward basis in years.
Let's talk revenue. What does the growth picture look like?
Full-year fiscal 2026 revenue came in at $41.5 billion, up 9.6% year over year. The real standout was Q4, which hit $11.2 billion, that's 12% growth, and the fastest quarterly pace in 2 years. The quarterly progression tells a nice story. $9.8 billion in Q1, $10.2 in Q2, $10.3 in Q3, and then the $11.2 billion acceleration in Q4.
So the business is actually accelerating, not decelerating. That's important context when the stock is getting hammered.
Exactly. Now, earnings per share came in at $7.80 on a diluted basis for the full year. That's 25.6% EPS growth year over year. Gross margins are stellar at 77.7%. Operating margin expanded to 21.5%, up from 19% the prior year, and a massive improvement from just 3.3% 2 years ago in fiscal 2023.
Wait, 3.3% operating margin to 21.5% in 3 years? That's a dramatic transformation.
That's the margin expansion story in one number. Salesforce went from growth at all costs to disciplined, profitable growth, and the results are striking. Net margin has gone from 0.7% to 18% over the same period.
Okay, cash flow. How's the cash generation?
This is where Salesforce really shines. Free cash flow for fiscal 2026 was $14.4 billion, up from $12.4 billion the prior year. FCF yield is 9%. Operating cash flow hit $15 billion. And the trend is powerful. Free cash flow has gone from $6.3 billion in fiscal 2023 to $9.5 billion to $12.4 billion to $14.4 billion. That's nearly a tripling in 3 years.
$14 billion in free cash flow. For a software company, that's a cash machine.
It is, and they're putting that cash to work. The board authorized $50 billion in share buybacks and increased the quarterly dividend. They bought back roughly $10.6 billion in shares during fiscal 2026 alone.
What about the balance sheet? Anything to flag?
Total debt sits at $17.2 billion with net debt of $9.8 billion. Debt to EBITDA is a comfortable 0.75 times, and interest coverage is excellent at 44 times. Now, the current ratio is 0.76, which looks low, but that's driven by $24.3 billion in deferred revenue sitting in current liabilities. That's not debt, that's money customers have already paid for services Salesforce hasn't delivered yet. It's actually a sign of business strength.
So the balance sheet is healthy, and that low current ratio is a feature, not a bug.
Correct. Book value per share is $63.25, and return on equity is running at 12.6%. They also started a dividend in fiscal 2025. Current yield is about 1%, with a payout ratio of just 21%. Plenty of room to grow that.
Lana, give us the verdict.
Overall, Salesforce's financial health is strong, the margin expansion story is real, free cash flow generation is exceptional, the balance sheet is clean, and the business continues to grow at scale.
All right, let's talk about what the street thinks. After Q4 fiscal 2026 earnings in late February, the analyst community had plenty to say. The consensus is buy, with 41 analysts covering the stock. About 74% rated a buy or strong buy, 23% hold, and just 3% sell.
The median 12-month price target sits around $280, which implies roughly 64% upside from current levels. JP Morgan has an overweight rating with a $320 target. Piper Sandler is at overweight with 300. BTIG maintains buy at the 310. On the cautious side, Citigroup is neutral with a $197 target.
So even the most bearish analyst on the street thinks the stock should be higher than where it trades today. That's notable.
It is. Now, on the insider front, March 2026 saw 25 filings totaling about $1.5 million. But these were mostly stock awards and tax-related dispositions. No aggressive open market buying or selling. Benioff himself holds 21.9 million shares, worth approximately $3.7 billion at current prices. Institutional ownership is dominated by the big three: Vanguard at 9.3%, BlackRock at 5.3%, State Street at 5.2%.
All right, bull case time. And there's a lot here, Lana. The biggest catalyst is Agentforce Salesforce's AI platform. Annual recurring revenue surged to $800 million in Q4, up 169% year over year. This is their flagship AI monetization vehicle.
And it's backed by real technology. The Atlas reasoning engine enables autonomous AI agent decision-making. They've introduced AgentScript, a new scripting language combining AI creativity with code predictability. And they've gone multi-model, supporting Google Gemini, OpenAI, and Anthropic models.
Then there's Data Cloud, which hit $1.2 billion in ARR with 120% growth. Over 50 trillion records processed. More than half the Fortune 500 is using it. This is becoming the central nervous system for enterprise data.
The Informatica acquisition for $8 billion doubles down on that data strategy. Informatica contributed $399 million in revenue in its first quarter with Salesforce. If they can integrate successfully, it strengthens the entire data cloud proposition.
And don't forget the margin story. Operating margins have gone from 3% to 21% in 3 years. Management raised the fiscal 2030 revenue target to $63 billion from $60 billion. They're not just growing, they're growing profitably.
Now the bear case, and it's real. First, the growth rate. Yes, Q4 accelerated to 12%, but the full year was 9.6%, down from 11% the prior year. The market is pricing Salesforce as a decelerating grower.
And the competition is intensifying. ServiceNow is growing at 20%, and has partnered with Microsoft to go directly after the CRM market. Microsoft Dynamics continues to benefit from its enterprise ecosystem. Oracle has been on a tear, up 142% over 5 years, while Salesforce stock has declined.
The stock itself is down 42% from its 52-week high of $296. It's trading near the bottom of its range at $170. The market is skeptical about whether Agentforce's ARR growth can sustain the 120+% pace, and there's a real question about how quickly AI translates into bottom-line earnings.
There's also integration risk. An $8 billion acquisition is never simple, and the enterprise spending environment has been cautious with delayed procurement cycles.
And while the current ratio at 0.76 is largely deferred revenue, it does mean Salesforce has limited short-term liquidity flexibility if conditions deteriorate unexpectedly.
Let's look at the peer comparison. How does Salesforce stack up?
Against Oracle, ServiceNow, and Microsoft, all competing for enterprise software dollars. On valuation, Salesforce's trailing PE of 21 times is the cheapest in the group. Oracle trades at 36 times, Microsoft at 33, and ServiceNow at 55. On revenue growth, ServiceNow leads at 20%, Microsoft is at 13%, Oracle at 9.5%, and Salesforce at 9.6%, roughly in line with Oracle.
So similar growth to Oracle, but at a massive valuation discount, and much cheaper than ServiceNow, despite similar market positioning.
On operating margins, Microsoft leads at 35%, Oracle at 30.5%, ServiceNow at 27%, and Salesforce at 21.5%. But remember, Salesforce's margins were mid-single digits 3 years ago. The trajectory matters as much as the current level.
Here's the bottom line. Salesforce is the undisputed king of CRM with a 21% global market share, a massive ecosystem moat, and a business that just generated $4.4 billion in free cash flow. The Agentforce AI platform and data cloud are genuine growth catalysts, and the margin expansion story has been nothing short of remarkable.
The number I'd watch going forward is Agentforce ARR. If it maintains triple-digit growth through fiscal 2027, the re-rating potential for this stock is significant. At under 13 times forward earnings for the dominant CRM platform in the world, the risk-reward looks asymmetric.
We'll close tonight with a quote from the man who started it all. Mark Benioff once said, "The business of business is to improve the state of the world."
And with $41 billion in revenue, $14 billion in free cash flow, and AI agents handling customer relationships at scale, Salesforce is certainly trying to improve the state of business itself.
That's our deep dive on Salesforce, ticker CRM, episode 114 in the books.
And as always, we present the facts. You make the call.
This is Charged Alpha, the S&P 500 stock encyclopedia. Before we go, hit subscribe, leave a review, and share this episode with someone who's got CRM on their watch list. You can find all our research at chargedalpha.com, and we are on every podcast platform. New episodes drop every week. We'll see you next time.
Charged Alpha is for informational purposes only and does not constitute investment advice. Always do your own research and consult a qualified financial advisor before making investment decisions. Past performance does not guarantee future results.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street